All right. Hello, everyone. Thanks for joining us live. Welcome to the Fellowship Wildlight webinar. Thank you so much for joining live, for watching this on replay. Thanks for taking the time. Without further ado, let's kick things off. So the things we're going to be going through today, we're really excited about this deal. We were on site just over a month ago, walking the neighborhood with Kevin and John. So we're going to be going over the executive summary, the team, the investment thesis, which I think is just absolutely undeniable when we're looking at the data, the market in Florida, the demographics, the development details, and financial analysis. So before we get into the team, we just wanted to kind of give a high-level overview of what are we talking about here. Well, this is a $96-ish million development. It is inside of a master plan community in Yulee, Florida, which is just outside of Jacksonville. And we're excited to turn things over to Kevin and John here. Before I do, and you'll have a chance to introduce yourselves in a moment, gentlemen, but just to give a high level here, this is a 205 unit senior housing development. And you folks have a pretty good amount of cash, your own cash invested in this project already. And I wanted to pass it over first to Kevin to just talk a little bit about what has already been done here. And that cash is not being taken back out as the rest of the investors file into this project. That is GP equity that is invested in this project. So Kevin, do you want to just quickly talk about, how we got here, and we'll go from there?
Yeah, Tate, if you look at the project timeline in the bottom right, you'll kind of see that we identified this as a market earlier in 2022 and began talking with Rayonier Timber, who was the master developer. They have an entity called Radiant Properties, and they developed the first 7,000 or 8,000 acres of timberland they own in Nassau County called Wildlight. And we saw their new corporate headquarters. It's a beautiful building. You'll see more about that later. Kind of come up out of the ground, some apartments. University of Florida Healthcare began to break ground on some facilities. And so we began to ask if we could participate with them in Wildlight. And that was around 2022. In October, we purchased the land. We went through entitlement, which in Florida takes a long time. We were able to complete the mass grading. So we basically raised the site 3 to 4 feet. And now we've acquired all the permits. So like you said, we're anticipating a start in Q2, just a couple months away. We've got John and I, between the two companies, BLDG and Fellowship Family, have about $5.6 million invested of our own dollars. And we also have, and that dollar, like you said, that'll stay in as our sponsor equity. We also have a couple of other close equity partners that have already invested about $1.5 million so that we could acquire the permits and finish all the entitlement so that we are, like it says, shovel ready and ready to go.
Amazing. Thank you. Moving into the team, everybody on the call is fairly familiar with the Turbine Capital team, but shout out to Noel Vinzon, which is our new investor relations coordinator, who is helping investors through their transactional processes and their account related support. So welcome to the team, Noel. John, would love to turn it over to you. Folks, a lot of people watched our interview from our sit down in Atlanta. So would love to turn it over to you, talk about the Fellowship family a little bit.
Thanks, Tate. And thanks for putting all this together. It's been really fun working with you so far. And I look forward to meeting more of your team and investors. But yeah, the Fellowship family started in 1978, the family farm I grew up on. My grandparents were pioneers in the senior living industry. I grew up with siblings and cousins. There were 10 of us. So I grew up walking distance from that original community. And that's kind of where I got my start, my taste of the industry. And so I always knew this is how I wanted to make an impact, make a living, and help others. And so, sorry, Tate, if you'd go back to the team, I'll introduce some of our team. And yes, so I'm the CEO, owner-operator. Kurt Fowler is our CFO. He's a CPA as well, and he's got vast experience in development and in operations. Lauren Sims is our VP of operations. She's been with us for 8 years and is very skillful in the way she handles her duties. And Carrie Tyndall on the call with us. Carrie, say hi to everybody.
Hey guys, nice to meet you all.
Carrie is our VP of sales and marketing and is excited about this project. She's got vast experience leasing up new developments like this. And so we're excited to have her join us tonight. Amanda Ziegler, Valerie Ketchum, George LaHood, and Crystal LaHood are all part of our team, and we have a lot more of our team. We have 500 employees, nearly 500, but this is some of our key folks who make things happen, and we really look forward to digging in on this project with everybody.
Thanks, John. And when we met you, it was like we couldn't wait to work with you because in this business, the operator is everything. And it's a match made in heaven between yourself and Kevin's team, who has incredible experience building. So with that, Kevin, over to you to talk about BLDG.
Yeah, Tate, thank you. Like Tate said, we seem to be have a great relationship with John and be able to work well together because he brings the operational expertise. We bring some of the development and construction expertise. I've been doing this for a little bit over 30 years. I was trained as an architect. You can see our team. Tim Palmieri helps us with all the financials. He'll be key in working with turbine and asset management, and with Carrie and that team on making sure we're tracking against our occupancy and other key metrics. They're going to report to you guys on a quarterly basis. Joseph Johnson and Michael Williams will be leading the project management efforts. They're the ones who are key in negotiating the construction contract, getting the plans finished, and getting us permitted. Amy, my wife, helps drive our culture and making sure that we're good partners, that we're communicating well, and that we're doing what we say we're going to do with all of our investors and other contractors, vendors, and others. Thompson is my partner, and Thompson really is our COO and drives our processes. He'll be helping us make sure that we're tracking the project budgets from the construction side, and again, staying on time and within budget.
Thanks, Kevin. With that, I don't know if you want to just talk briefly about some of the third parties that are involved in this.
Yeah, I can do this. So Stuart Connors is an architect that we met. They're out of Charlotte, North Carolina. They are experts in senior living. And so John's operational team had a vision for how they wanted to run the property, the size units, how they wanted to be able to interact with residents. And so we brought Stuart Connors on board, and they were able to take the vision from the operating company and then match that with the kind of the pro forma expenses and costs that we're allowed to have for the project to work, and then gave us the product that you'll see in a little while. Elkins is the general contractor, the part of the Perry McCall family of construction companies. I've worked with them for close to 30 years on different projects, and they're local to Jacksonville. So they've got a huge sub base. Not only do they do multifamily and senior living residential, they also do hospitals and more institutional work. So they're going to kind of make sure that we have the high quality hospitality feel in our lobbies and amenities, but also make sure that we have the residential finishes and cost in the units. Niles Bolton is a highly regarded multifamily architect. We use their interior design expertise. They're the ones who will help us pick out all the furniture, make sure that we've got the feel and the culture that we're expecting throughout every nook and cranny of the project, from the dining room to around the pool, back up to the sitting areas in the lobby again. And ETM is a local civil engineer who helped guide us through all the stormwater guidance, to make sure that when storms may happen in Florida, that we'll be high and dry and be able to withstand anything that Mother Nature may throw at us.
Excellent. Thank you. With that, I want to do a little bit more of a deep dive on both of your companies. So starting with John, you've got this awesome video that we wanted to share. And I don't know if you want to just talk through a little bit of the family history while this is going.
Yeah, thanks. So some of these photos are just some of our family members in action over the years. That was five generations of my family. My wife and I at one of our sites. That's my dad and my oldest son. We've been very fortunate to have just 48 years of a successful business in this industry, and all of those years haven't been easy, which is good because we're battle tested and we've seen just about everything that could happen, we believe. But we're very engaged with our teams, with our residents. That's a local restaurant we like to take folks to. That's a sunflower patch on the family farm that we like to do photo shoots with residents and team members. And it's hard to not have a good day when you're in the middle of a big sunflower patch. But you saw some of the aircraft photos. We have a grass runway that we at our legacy site, original site on the farm. And occasionally I'll fly in and take some folks on rides, especially residents who have some aviation history or some connection. So that's always been fun. So it's just really neat to have several generations of the family involved in the business. I think it makes us unique. And I'll go back real quick to the relationship with BLDG, Kevin and his development team. We're very fortunate, Fellowship's fortunate that Kevin has allowed us to be a part of this process starting from the original design. Of course, we invested in the land together, and but Kevin's been very welcoming to have us weigh in on the design features, the width of the doors, and the door swings, and the kitchen layouts, and the unit designs, and everything. And so we feel like this is a match made in heaven. I think we heard Tate say that earlier, and but it really is, to have a developer that understands what he's good at and where he needs to pull in an operator, to fill in the gaps. And likewise, I know that I'd need someone like Kevin and his team to pull this off. And so we're very excited to be doing this together. Fellowship currently operates 11 locations and have almost 500 employees. And we have, 3 projects in the pipeline in the near future that we're excited to bring on board. The other neat thing about where we are right now, and what I'm excited about with Wildlight, is we're still a relatively small operator. We're big enough to have a good, robust team, but we're small enough to pay attention to the details. And so it's just a good time to be in this business, and I love where we are as a team.
Well, we'll talk a lot more about the time in the business, but this is not the first time that you and Kevin have worked together. By the way, this deck will be available in the deal room. And so I know there's a lot of fine print in here. You're welcome to download it and really give it a thorough read. But for time, we're just going to kind of skip over a few things here. But this is not the first time that you've worked together. In fact, we have it's all the way down here, but successful JV sponsorship that we'll talk about in a few slides. I want to give you an opportunity to talk about these 2 projects and the work that you and Kevin have done so far.
Yep. So these are 2 representative projects that we acquired in the past 12 months. And these were both distressed or semi-distressed, senior living deals that Kevin's team helped us underwrite, and, with our operational input. And so far, things are going great. And in a lot of cases, we're exceeding the expectations that we set going in. But a year ago, we were able to buy properties like this for a fraction of what they can be bought for today. We went through a window of time where there was an abundance of distressed senior living assets on the market. Coming out of the pandemic, bank loans were coming due. They had overextended their welcome with their lenders, these developers, owners, because the pandemic were tough years for this industry. And so they extended their loans as long as they could, and they had to sell before they were completely stable. And so we were able to pick these up at good prices and have already, made great strides to getting them to stabilization. But what we're seeing now is new development starting to make sense. And so that's why, we're excited to present this to you today, because there's the distressed product is not as abundant as it was.
Right.
Those are, mostly retraded now. And occupancy is at an all-time high in the industry. There's more units occupied today than ever in history. The National Investment Center for Senior Housing has come out with a report in January documenting 18 consecutive quarters of occupancy growth coming out of the pandemic. And we have our oldest baby boomers turning 80 this year. And that's our target range. Our target age is 80 and up, for this assisted living memory care product.
Thanks, John. Kevin, back to you to just a little deeper dive on BLDG. There's a few slides here that you can tap through if you'd like.
Yeah, Tate. And again, these are just some representative projects. Over the last 30 years, our team has developed, we're primarily residential. We've done some for sale condominiums and then within other partnerships, we also did a lot of student housing and some affordable as well. We were able to sell off a portfolio of projects over 2021. And from that, really looked at what we wanted to start into and building a new portfolio, and partnered with John. And again, trying to find an operator who wants to invest and have their equity in the projects instead of just being a third party operator. So John was open to coming in to a joint venture. The project at the top is a 300 unit multifamily project that we completed last year. It was under budget and in a time of, with a lot of kind of inflationary trends. We were able to manage that project successfully and get the CO and get residents moving in. The project on the bottom left is an active adult cottage project that we broke ground on earlier this year. And it sits beside another project that John had originally developed in 2017 that we collectively expanded about 3 years ago. So one of the things you'll see with Wildlight is that it's got independent living, assisted living, and memory care. And those kind of feed on each other. The independent living will become a feeder for the assisted living and memory care. And this active adult cottage project will do the same thing for our project in Milledgeville. And like John said, the market's changing and there's not a lot of larger projects with a high percentage of independent or active adult units. And so we think all the investors are looking for these unicorns, and we think we're going to develop them and really have a good opportunity to come to market with something that everybody's wanting to buy in the next couple of years. Again, we've participated, Thompson, Tim, Joseph, and I participated in about 25,000 units with roughly a $2.8 billion value. The sales cycle that's mentioned in the middle bullet point, that was a portfolio that we had either self-developed or acquired and assembled that over a couple of years, about 15 years. We had an equity partner from Boston. We're able to sell those, again, coming out of COVID. And it's probably all we need to hit on that slide for now.
Well, and this is just a great representative bill that just completed, right?
Yeah, it's a great project that's in the Panhandle. And it's just representative of doing work in Florida, where you have a lot of design constraints, whether it be from the weather or the state and just permitting. And so this project, again, has been completed. It's being occupied, and it's one we feel that it shows very well, and it matches where the market's headed.
So we typically don't spend this much time at the start of a webinar talking about the team and the track record. But I think in a project like this, it's so important because this is a complex asset class. This is not self-storage. It's not industrial where you're just throwing up some walls and leasing it out. This is an operationally intensive business. And so we wanted to take the time to adequately convey the expertise that's on this team. It really is a match made in heaven. And the meshing of your two teams is just fantastic. So when we flew down to Florida and we toured and met in person, had dinner, we could really see that synergy there. And we're just so excited for what you guys are bringing to market. So I'll talk a little bit about the investment thesis. And of course, John, as an elected state representative and someone who is in the Georgia House of Representatives, playing offense and defense on these bills. You can probably talk a lot better to it than I can, but maybe I can talk objectively and you can talk subjectively. Carrie, we spoke a little bit before the call about you maybe talking a little bit about what you're seeing on the ground level in terms of leasing. But here's some of the data that we're seeing. And this is one of the reasons why we've been tracking this asset class for the last 10 years. And I'm glad we didn't get into it. I've said this on the podcast that I'm glad we didn't get into it when we wanted to in the late 2010s because COVID rocked the asset class. But we're at an inflection point now where by 2040, the 80+ year old population is forecasted to nearly double. Construction is at its lowest level in 15 years. And there's this moment in time where there's an opportunity to take advantage of these trends. We have a full Green Street report that's available upon request, but I wanted to pull a few data points from it. The first here is, of all the 20 different asset classes that Green Street is looking at, the NOI growth, the projected NOI growth of senior living is the highest. We'll get to that in the next slide. But there are the risks here have been very effectively managed by John's team. And I wanted to call out one thing here, and that is that it's operationally intensive with growing labor shortage. One of the biggest risks to a senior housing project is labor. So John, do you want to talk a little bit about the payroll that you have on staff and the culture of your company and how you manage that?
Yes. So Fellowship has a great track record of retention on our leadership team. Our frontline team, we have good results there too. The reality is a lot of the frontline caregiver level jobs do turn. And these are people who are either on their way up in their career and they use this as an entry into healthcare or hospitality. And we can groom them and raise them up in our leadership stack or help them, grow their career, somewhere else. But at Wildlight, what we're really excited about is where we're positioned. A lot of the labor lives to the inland, to the west of our site. And they're driving past our site to get into Jacksonville and onto Amelia Island for jobs with other providers or with the Ritz-Carlton or the Omni Hotel and restaurants. And so we'll be able to capture them a lot closer to where they live. And so we're strategically located, but we also have lots of other retention initiatives that we have in the works. And our longest tenured caregiver has been with us 40 years. That's not very common, but we're a host site for certified nursing aid classes. And so we get to do a lot of on-the-job interviews as these students are learning the job. And so we do a lot of things to make it a fun place to work, rewarding in ways more than the paycheck. We like it to be filled with purpose so that people are drawn to work with us.
Well, and that's another thing, right? The quality of the facility. No one wants to work. No one wants to live in a 30-year-old, 40-year-old facility that's depressing to be in. Nobody wants to work there either. And so this is going to be a beautiful new facility that people actually want to spend time in. Before we get there, I'll point people to download this slide deck and really read this because it's very impactful. But the things that I want to call out here are, first, the population growth. This is starting in 2026, where we are here. You just look at the demographic trends of the population growth in this older demographic and the supply. And we are right here in this valley. If you've been with us for some time, you've seen the massive supply waves in multifamily and industrial coming out of COVID are just huge, really in every asset type. This is one of the only commercial real estate asset classes that did not see a massive wave of supply hit the market post-COVID when debt was cheap and everybody was just building like crazy. So we've had this, if I go to the next slide here, we had this massive drawdown in net operating income, about 40% from peak to trough during COVID. So most of the huge NOI gains that you're seeing here over the last few years have just been recovery, but we're above pre-pandemic NOI levels now. And when you look down here, SHOP is senior housing operator versus triple net senior housing. And that's what we are here with Wildlight, is senior housing operator. This is kind of a funny graph that 2009 through 2025 NOI growth is on the x-axis here. So single family rentals did the best. Congratulations. If you invested in a single family rental in 2010, that was your best performing asset in terms of revenue growth. But the y-axis here is what is expected between 2026 and 2029. And senior housing is literally off the charts. This is from Green Street. Of any asset class that you could invest in right now, it is projected to have the largest growth in net operating income over the next 4 years. So just want to point that out. Quickly turning to the market, Kevin or John, do you want to take this? Just talk about Jacksonville and Yulee, just anecdotally.
I'll start, Kevin, and I'll turn it over if that's okay. So growing up, Amelia Island is a beach town that a lot of people, have second homes or live.
That's Amelia Island, if you're not familiar, is right out here.
That's right. And Kevin and I both live in Valdosta, Georgia, about 2 hours to the northwest. And so for years, we've traveled back and forth to Amelia Island, and Yulee used to be a bunch of planted pine trees. But over the last, 5, 7, 10 years, it has just exploded with growth. And now within about a mile of our site, there's 3 hospitals. There's, shop retail, there's healthcare, there's, schools, rooftops going up everywhere. And so it's been neat to see the explosive growth. And Kevin had the foresight to build a relationship with the Rayonier master developer several years ago. And that's when we got a contract on the land and went hard on the land and have held on to it for a few years, long enough to make this project make sense. And so I appreciate Kevin's foresight in doing that. But we're conveniently located just north of Jacksonville, just I think 20 minutes from the Jacksonville International Airport, and everything Jacksonville has to offer. About another 20 minutes to the coast, if you go east. So, and we get calls regularly from people. We haven't even formally announced the start of this project, but people find us online and they call or they inquire online and ask when they can get on the waiting list, to be one of our first residents. So, Kevin, you want to say any more about Jacksonville and the area?
Yeah, and I think a lot of you may know more about it, but Jacksonville-Duval County is kind of one metro area. And it's grown substantially south into St. Johns County, and it's grown a little bit to the west, but it's really also kind of grown to the north. And there was an industrial ring and kind of the airport that was on the north side that was kind of a cap on growth for a long time. And then when Nassau County and Rayonier came up with their kind of Tides to Timbers program of how Rayonier would begin to develop their properties, then that's when Nassau County and Yulee really started to grow. You've got some really great golf courses on Amelia Island, but also like Amelia Concourse and other things that are in Yulee and on A1A kind of going back towards the coast. So there's a lot of rooftops there. I think there's probably 3 Publixes within a 20, 12, 15 mile run right there. The newest one is in Wildlight. Jacksonville is also a medical town. You have the Mayo Clinic, you have Baptist Healthcare, which is partnered with MD Anderson. You got UF Shands Healthcare. And so that, like just south of us again, near the airport, about 12, 15 miles south, they have full cardiac and oncology services and a very large UF hospital, which is important for seniors. They have healthcare issues. And what's great is because of the growth in Wildlight now, we'll talk about it in a minute, but there's 3 hospitals just so easily within a mile. The University of Florida Healthcare within Wildlight, Baptist Healthcare is just outside of Wildlight, and then HCA Healthcare is at the same exit. And I don't know, Tate, if you want to share the video about Wildlight for a second.
Yeah, I think I put this into the deck because I think it gives a good sense of what Wildlight is. So Wildlight is a very large area of what used to be timberland. And in any case, it's on the map here. We're not going to watch this entire video, but
Let me tune one more time before we start.
Everybody hear that audio?
You ready? Let's do it.
All right. So
the idea that became Wildlight started by some really insightful stakeholders that saw the growth that Nassau County was experiencing, and had this thought that we need to make sure that we're thoughtfully planning for it.
So we sat down with the team from Rayonier and Radiant, and we really started talking about, okay, schools, parks, roads, wetlands, community centers. What are the really cool cultural aspects that we want to protect in perpetuity? Let's tie those into the social and civic fabric of the community.
Growing up in Nassau County and in Yulee, I can tell you it has changed dramatically over the past few decades. Growth is going to happen. We can't stop that. But what we can do is we can do it responsibly, and we can embrace conservation, and we can embrace our communities and our neighbors.
Nature is the core, right, of a lot of our design.
All right,
Let
so
me tune one more time.
gives you an
before we
idea
start shooting,
of
just
it. We have the website for Wildlight linked in our deal room. If you want to go poke around, it's there. But essentially, we have this massive. How many acres is the entire thing? The town district is what is currently built.
The town district's
phases are follow-ons. Say again.
Yeah, the town district's about 7,000 acres, I think. And then what it says, the next big chapter, and the garden district, that's about 24,000 acres, which has been entitled for just under right at 24,000 homes. So like in the town district next to us, you've got a lot of single family residents, 2 or 3 multifamily developments, and these are all existing, Tate. So when you look at the
right
existing, there's 2,400 homes. There's some commercial. Part of that is Dale Webb is behind us with 55 plus 4 sell homes, 660 lots. And then, like it says, there's the trail connectivity here, the master planning. There's walking trails, bike trails, there's golf cart connectivity. And so that's one thing. Our site is in the little circle, the orange circle, kind of near A1A. The hospitals are closer to the interstate.
So this is some photos of what it currently looks like. There's, this is not theoretical. It's already been built and it's well on its way. Of course, the development to expand this area will continue over the next decade plus, but this is what actually currently exists. And we have some videos that we took when we were down there that will be circulating. Something else I wanted to point out is that Rayonier is the master plan developer. Wildlight is the name of the community. And Rayonier's new corporate headquarters is located within Wildlight, just a stone's throw from the fellowship site. So it's kind of hard to see here, but this says One Rayonier. This is their new corporate headquarters. So this is the firm that's developing all of this in conjunction with conservation land, and they're building schools, parks, trail networks, retail. So they're right next to this, and within, I don't know, less than a quarter mile from Fellowship, there's a Publix grocery store, and then a 660 home Del Webb community, which is 55 and over. So we stopped into the leasing office. We talked a lot about the fact that, people that are trying to move away from, let's say, Minnesota, and they want to bring their parents, their aging parents can live at Wildlight. They can live at the Del Webb community. And of course, that's a natural feeder because you have the 55 and up community, you have the independent living, you have the assisted living, and you have the memory care. It's all right here. And as you mentioned, Kevin, and I wanted to show this as well. You can actually go onto the website and see homes that are for sale within the community currently that have already been built. So this is all, we're building right into this infill. The Publix is there. And Kevin, you were mentioning the hospitals that were right next door. This beautiful University of Florida Healthcare Center is right here. And so, you come out the driveway from Fellowship and you're right here at this healthcare center.
And I think it's important to understand, like you said, with Del Webb, which is number 17 on this, if you have a 60-year-old couple who move in, then they're wanting to relocate their 85, 87-year-old parents. And so that becomes a natural draw for us, as well as if they move in there and they're in their mid 80s and one of the spouses has a fall problem or they have maybe Parkinson's or dementia, then we're the natural progression for them to be able to move in and get a studio apartment. And maybe one spouse lives in the studio apartment where they can still take care of themselves and cook, and the other spouse goes into assisted living or memory care. And so we really think the synergies with Del Webb and the hospitals is a huge, huge plus for us.
Definitely.
And being the exclusive senior living provider in this entire development is...
You speak a little bit more to that because, in the entire development.
Yes. But we're not contained. We will draw people from outside of the Wildlight development as well. But being the exclusive provider in here that's accessible via walking trails, golf cart paths, we're right next to a park with pickleball courts and other amenities. And so I think this might be a good time for Carrie to jump in and just kind of speak to the opportunity we're sitting on from a sales perspective.
Yeah, thank you so much. Thank you for letting me be a part of this. This is such a great opportunity. I think it's such a sweet spot. Like John mentioned, it is, we talked earlier about supply and demand. There is such a high demand. Just to kind of share a story with you all, I was visiting the area last week, visiting some of our competitors, Amelia Island, and, we're seeing wait lists. We're seeing long wait lists, 6 months to 9 months. So, there is that need. And I think we have just a great opportunity here to really, it's all about convenience. So having the opportunity to really offer that with folks moving from up north, moving to this area, expanding out of Jacksonville, I think it's going to be a great thing. And I'm super excited for the opportunity to be a part of it.
We're going to talk more in a little bit about the lease-up experiences that you've had on some previous projects. But before we get there with that, we want to talk about the actual development. So John and Kevin, I'll pass this over to you, of course, because you're the experts. But let's talk about what are we building here?
I'll go ahead and take that first part. And again, like we've talked about, we're going to have a full continuum of care. And we've got some active adult cottages that are out front. There's about 8 cottages. And then there's the IL apartments. It's 4 stories. If you look across the pool towards the rear and to the right would be the independent living apartments. Those are full apartments with full kitchens. They can also purchase meal plans from them. John and Carrie's team will be able to stand up some supportive services. Maybe they'd like for us to change their sheets, do linen service, or do light housekeeping, but they don't necessarily need a lot of medical care yet. But these communities come together, they create their mahjong clubs. Like John said, there's pickleball around the corner. And what we found in a lot of our communities, the independent living residents may still be employed. They don't necessarily have to all be retired, but they want to be somewhere vibrant. They want to be somewhere where they can also go visit their kids somewhere else. And so they can lock the apartment and know that somebody's here to take care of it. They don't have to worry about who's going to mow their grass or what happens if a storm blows a tree down. And so we're kind of there to take care of that. So when you look at this continuum of care and we have the people moving in from these other areas, the light care would be IL. They would be able to have some meals, light housekeeping again. But then as you move into assisted living and memory care, you'll see that that's really a third of our units. And the market study sees that need continuing to grow. But we think we're going to be able to feed within our community to really be supportive What Fellowship does well is minister to the families, the children, the grandchildren, and just anecdotally, John may not tell you, but I will. But he and his dad I've seen them preach funerals. I've seen their staff at funerals for people we know that have lived with them. And they just had a wedding 2 weeks ago where I think it was an attorney in Atlanta that wanted his grandmother to be able to attend his wedding. So they leased the Fellowship Chapel to be able to have their wedding. And you just don't find that with a lot of senior living communities. And so I think it speaks volumes to the Fellowship team. And Tate, I'm sorry, I don't know why my keys aren't moving this, but you can go to the next slide.
Okay, no problem.
And again, we have plenty of parking. We'll have some covered parking because a lot of the IL residents will continue to be driving. And we'll progress from the right side of the plan. We'll be independent living. You'll have your amenities, your kitchen, your dining in the middle of the building. And then memory care will be its own one-story subset kind of to the northwest. And then to the southwest, we'll have the two-story of assisted living. It's the small things like the pool. We've designed it so it has a ramp that allows residents to walk or roll into the pool. A lot of senior living communities have a lift, but as John said, we're trying to preserve dignity for people. And when you have to have somebody else put you in a lift and put you in the pool and get you out, it becomes a barrier to people being able to enjoy the latter years of their life. So we think we've hit a lot of the design points that'll make people feel comfortable, again, retain their dignity and have a great place to live.
We've talked about this so many times before. John, you and I talked on the podcast in Atlanta about how baby boomers have redefined every segment in their lives, right? I mean, they redefined music, arts, technology, everything. And now they're moving into this phase of life. They're going to redefine this. They're not going to move into the same facilities that our grandparents did, 15, 20 years ago. They control 51% of the wealth in the United States. And, this type of product just does not exist in the marketplace, at least to the level that we need.
I agree. You hit the nail on the head. And this is not the place for someone to go and do puzzles and watch TV in their room all day. This is a place where people can live life to the full and be as active as they choose to be and remain integrated into the greater community around them. And not one of the design features I'm really excited about on this Wildlight building is having some public facing features that the adult children could enjoy with their parents, like the salon.
Let's talk about that. That's huge. Yeah. We talked about that on the podcast. Things like coffee shops, right?
Yeah, like coffee shops, bistros, multiple dining venues within the property, the salon, the fitness center, the theater, the pool and the outdoor courtyards. And I wanted to point out when we were on the other slide, one down from this, I noticed the ponds here. These are storm retention ponds, but we've made them water features and they're already built. They're already there. That's part of the mass grading and the site work that Kevin's team has already, made happen. And so we keep saying this, but this is just one of the most unique opportunities that we're able to be a part of, because I think the site work that's already been done has shaved, Kevin, 4 or 5, maybe 6 months off the construction.
At least. And that just reduces your construction duration and your construction risk for weather delays, because we'll be able to go in and immediately start utilities and paving.
Yeah. With that, we're moving more into the financial side of things. So looking at some market comparables in terms of sales. We have full underwriting file, which we're going to be putting on our deal room shortly, which good luck getting through it and understanding it. It's a beast, but that'll be there available to you. This project has been underwritten to a 6.25% exit cap rate. Happy to explain offline what that means, but essentially that is the multiple on the income that the property is selling for. We think that that's very conservative based on the sales comps here.
So Tate,
yes, please.
Maybe your audience knows this, but the higher the cap rate, the more conservative the exit price is. And so the lower the cap rate, the larger the exit price. And so we've modeled this, we think, conservatively above the cap rates that have already been proven, just to be sure we're not getting overly optimistic.
Excellent. And these sales also occurred back when COVID was still a thing. I think, 21 through mid 22 here. I think that's when Omicron was a thing, right? So, this was a challenging time to be selling senior living facilities, and they were selling for very attractive cap rates.
Yeah.
On to the rentals. John, do you want to speak through this? Because there's some nuance here between the base rates and the additional fees.
There is. So the way we've modeled this is we're showing the average rate we're anticipating all in this base rate column for IL, which is independent living, AL, and memory care. And so this is going to be the average rate that we achieve. In reality, some of that is going to be part of the care fees based on the person's needs. And so when you compare our base rates to the base rates down the list, make sure you see the care fees that the comps are charging and add the total up. And that's how you would compare to our, the base rate we're modeling.
Carrie, do you want to speak to just rates that you're seeing and rental rate increases that you're seeing at the
absolutely.
level?
Thank you, Tate. I'd be happy to just kind of touch on that. I think, we're right in line with what we're seeing here, with what traditionally we have currently in that market or communities near that area, Jacksonville and Amelia Island. So, I think we're very competitive, ideally, with where, we're seeing this model versus, what we have already in the area. So, with something new coming out, this is just going to be more of an opportunity for us.
And
Carrie, we'll be the newest. We'll be the newest product at rates that are very comparable with these existing, comps. And Carrie, do you mind talking about rate growth that we're expecting? By the way, we modeled 3% annual rate growth, but Carrie and I were just on a call with some of our team earlier today and are going to push a 7% rate increase at some of our communities. And in some in January, just already absorbed a 6% rate increase. And so we think we're going to beat the model.
Yeah, I think it's very conservative where we've kind of modeled it. Typically in this industry, in my experience, we've always run, it goes back to, I think, Tate, you mentioned this earlier, it's all about the operational piece. And if we're doing it right, we have the opportunity to really push that rate and get a little bit flexible with it. So traditionally, I've always seen, a 6 to 7% increase.
And that allows you to really handle how you want to right size your staffing and make sure you're compensating your staff well to reduce turnover. But I was going to note too, what's listed as number 4, Savannah Grand at Amelia Island. That's one of the acquisitions we did last year. And John and Crystal and the team kind of got in there and updated the facility with new wall coverings, new paintings. We painted the facility and started to see immediate occupancy and rent growth opportunities there. And we began to turn some units and fully update those units. And I think we're seeing, an increase of $800 to $900 a month. So that's a 1997 property that has been updating versus, we're going to deliver a brand new project in 18 to 20 months. And so I think that just helps you understand how tight the market is and how high the demand is.
Good point, Kevin.
Yep. So moving into sources and uses, again, this presentation is at your fingertips. You can download it from the deal room. It'll be uploaded there in the next hour or so if you want to go through this in fine detail. But Kevin, any call outs you wanted to make on this? Just shy of a $97 million capital stack to build this.
And if you look at it, when you see total FMB plus Peachtree Group, that's an interesting thing in that you may not have seen it. You may see it in the deal room. We're using CPACE, which is it's a resiliency, stewardship kind of financing they'll actually be 47 million roughly of the project. The bank's about 26 million. It was 26 and 46. But that's kind of we combined those two to be kind as both as debt. So your debt load's kind of in that 74%, but only the Farmers and Merchants Bank is the only true debt. CPACE is an 8% kind of hybrid lending solution. And so it's got a longer maturity than the regular debt, but we've kind of lumped them together just because of the way they're treated. And again, of that total 26 million of GP equity, if you think about the fact that the sponsors already have 5.6 million in it, then, we're carried a lot of the load to get us to this point. The land costs, we just received an updated appraisal last week. I don't know if Tate has some of that in here, but the land,
I sure do.
The as is land is 6.8 million. The market value at CO. So once we finish construction, really with no occupancy, they estimated the value to be 112 million. So if we're at 96, 97 now, that's a 15 to 16, $17 million increase in the 18 months between now and we finish construction. We had originally underwritten, and for month 30 to 32, when we refinanced, about 125 million as a value, and the market study or the appraisal came back that they think we'll have an $132 million value once stabilized. So and Tate had asked us earlier, stabilization, basically break even for debt service and for all operating expenses is 63%. So if you think about that the 132 million is a significant gain to have completed construction and let Carrie's team kind of get us to about 75-80% occupied.
And I want to call out that the net target returns to investors is based on the 125, right? Not the 132. Basically the appraisal came in higher than what we had expected.
And really the returns are generated over the full hold period, in that, of
course,
you'll invest your dollars, you'll get some return of capital at refinance, and then there'll be some cash flow, and then the real return comes when we sell the property.
Before we get to that, I just wanted to look at the lease up here, and we're giving ourselves till year 3 after construction to lease this facility up. Carrie, do you want to talk anecdotally about what your experience has been from lease up from some of your other new builds?
Yeah, absolutely. Thank you so much. I think no doubt in my mind that we'll be on track. Year 1, pre-leasing, we're looking at 42%. That's a standard, what I've seen in the past. I think supply demand, we're going to see a shift with that. And I think we're going to be able to beat that. Year 2, around 87%, and stabilize out at 93% for year 3. So no doubt in my mind that bringing on a team, I think ideally from a sales and marketing side, you want to bring someone on board between, a year to, 9 months before opening, just to really work through and partner and, focus on those lease ups. In this, with the continual care model, in my experience, I've seen, it's a want versus need base. So, you're going to start to see more the independent living, pre-lease first, assisted living and memory care coming second, just based on that. Again, the want versus the need of base for that. And, I think we have some opportunity to be strategic with some of our sister communities to help with that as well. So I feel really good. This is what we've typically seen in the past.
And something, I'm sorry we don't have a photo of it. We should have it in the deck, but there is a purchased leasing office already in existence and furnished in the Wildlight community and about to open the doors.
Yeah, I think that's going to be great. I think opportunity really to bring someone on board and really get invested and, a part of this community as it continues to grow is going to be ideal too.
With that, I'd like to kind of take a look at the capital stack first. So this is about 73% debt, 27% equity. Of that equity, over 21% is coming from Kevin and John here. Like we said, they've already invested that capital over the last few years into this land, buying the land, doing the entitlements, civil engineering, site work, permitting. I mean, all of these dollars have been pre-spent, and those dollars are staying in the deal. So we really are the 11th hour capital into this deal. And as soon as we round out the capital stack, shovels are going in the ground and we're going vertical. There are no hurdles to get through in terms of permitting, entitlement, anything. You guys are ready to go. The other thing I wanted to mention here is Turbine will end up being somewhere between $6 and $10 million of this capital stack. The rest of it is coming from some family offices and some institutional partners that you guys have. So this is not a retail deal, so to speak, which is one of the reasons why we're so attracted to it. Share classes are as follows. As you can see, 50, 250, and 1 million. Some preferred returns there will start to accrue as soon as we break ground. You got a 7, 8, and 9% pref with the splits as follows, and the target equity multiples based on which share class you're in. We wanted to show a sensitivity analysis. This is for IRR, and I think it'd probably be easier to look at equity multiple. This is just a change in exit cap rate and a change in rent growth and how that would affect the investment returns net to you as the investor if that should occur. So we've pretty conservatively modeled a 3% rent growth. As Carrie mentioned, we think that being on the right-hand side of this chart is much more achievable, especially because your company has been recognizing 6% rent increases, 7% rent increases, and that's before this tidal wave of demand has really dumped into the market. We're seeing over the next 4 years the demand for this type of product increasing exponentially, and you're seeing these high single-digit rate increases even before that massive supply wave has really materialized. Additionally, on the left-hand side, we're just seeing change in cap rate. So 6.25 we think is a very conservative cap rate to be modeling, and if we can get a lower cap rate, particularly builds that have a higher independent living component tend to trade at slightly lower cap rates. And so we really do think that this product could bend into the upper quadrant of this chart as well. Of course, the flyer there is interest rates. If we see some big spike in interest rates, of course, that negatively impacts cap rates and vice versa. So I do want to also call out in the bottom left-hand side of this chart where, we're not going to sell this building if we're in a high interest rate environment. There's some sort of a pandemic that occurs, another pandemic occurs, and we can't sell this thing in an attractive market. We're just not going to sell it. We were looking at the analysis of just holding it. And what was the break-even occupancy again?
About 63%.
Right. So we only have to be 63% to cover our carrying costs and be profitable. So there's no reason to sell this thing anywhere here in the bottom left-hand side of this quadrant, but just wanted to point that out. So project timeline, this vertical bar here represents today. Everything that has been done in the past has been the land purchase, the mass grading, the permits, and we're looking to go vertical with this thing in a couple months. Construction, Kevin, you want to talk about the construction timeline, and maybe John or Carrie about the pre-leasing and how those will overlap a little bit? We already alluded to it a little bit during the pro forma, but I think it'd be good to talk about that, and then maybe through the stabilization and refinance and what that piece will look like.
I think the construction side's easy. We pulled the permits in January. And so once we have the project fully funded, then we'll be able to break ground. Like Tate said, we'd love to do it in March. It'll probably be somewhere in April. And then it'll be about a 20-month construction duration. Because we've already got the site work done, then we're hoping we can pick up a little time and maybe finish in 18 months. But that's a pretty conservative estimate.
Yeah. And like Carrie mentioned earlier, we will bring on, leasing specialists and some leadership, that will run the property, manage the property a few months ahead of opening. And we've already got an office for them to work out of. And we already have, talent, on our team that lives in this region. And so we feel very well positioned to, have a successful lease up.
Excellent.
And I think, like we said earlier, we've got a property on Amelia that we acquired that's 20 minutes to the east, and one at Ponte Vedra that's about 30 minutes to the south. So Carrie, Lauren, John, Crystal, they're already there on pretty much a bi-weekly basis. And so now it's just beginning to respond to those residents who are reaching out.
Excellent. We can kind of talk through the stabilization and refinance while this plays. This was during our site. There's TJ there and John. But once we get certificate of occupancy, C of O, we're targeting that 30-month lease up period. As you mentioned, Carrie, I mean, it could be significantly faster.
Yeah.
Look, I want to clarify too, that 30 months, that includes the construction duration. So like Carrie said, we're going to be pre-leasing to 20 to 25% during construction. And so when we finish construction in month, let's call it 20, we believe she'll have us pre-lease primarily on the independent living to about 25%. Then we'll lease to 42% within that second year. So by month 24, we'll kind of go from 25 to 42%. And then year 3, we think we'll get in the 80%, which takes us to stabilization when we start to look at refinancing. So that's not 30 years after construction. 30 months after construction, that includes the construction period.
Yeah. Excellent. And if you look at the pro forma, don't get confused. Year 1 of the pro forma is year 2 or maybe 3 of the project, because, construction happens before pro forma starts.
Thanks for that clarification, John. So if you ever wanted to know what $6 million looks like, that's it right there. With that, next steps, the deal is live on our investor portal. We'd love to have you. We're very, very enthusiastic about the project. We're confident in the team's ability to execute. We're going to be putting our own dollars into it. And we're excited to launch things here today. So with that, we've been going for an hour here, so we want to turn it over to Q&A. I know we've got a bunch in the chat already, so I'll start from the top, but I know that there's going to be a few questions. I'll start with these. First off, K1 timeline. That's always a little bit of a point of frustration sometimes when you're investing alternatives. I will say that these are probably going to be Q3 K1s, right? So a little later in the year, if you're not comfortable with a late K1 and doing an extension, this might not be the deal to invest in. Would you agree with that, Kevin?
Yes. By the time we get all the year-end financials back and kind of work through all with the accountants and auditors, that kind of puts us right at the end of Q1. Q2, we start to distribute things and talk to everyone, but you're going to need to file the extension. We won't be able to get it in before March 15th or April 15th.
Excellent. So, but it will be there before the extension deadline.
Yes, sir.
Another question is, will we be investing through Turbine in classes A, B, and C? Yes, we have joined the GP team here. And so there's no difference between Fellowship, Wildlight, and Turbine here. We're part of the team, and there's basically just one offering here. Another question that I know will pop up is this suitable for a self-directed retirement account? I have some exciting news that we are looking at. I can't promise that we're going to do it yet, but it's looking very much like we're going to be doing our first UBIT blocker on this deal. The reason is that for those of you who are tracking this stuff, probably noticed that the leverage ratio is slightly high on the loan to cost. Now, real quick on a side tangent, you might say, "Ooh, it might be a little highly leveraged. Does that make it risky?" Well, when you look at the appraisal value of 112 million, that's really the ratio that you want to go after, because once you deliver the project, it is quite a low leverage ratio once you look at it in terms of loan to value instead of loan to cost. But on that loan to cost, 73% debt. So the UDFI exposure is going to be notable. And because it's an operating business, there is going to be UBIT exposure. So what we're exploring is a UBIT blocker. And what that is it is doing a C Corp that sits in between the SDIRA investors and the partnership. And essentially that just flows through. So the IRA investors come into the C Corp. The C Corp then invests in the partnership. There's no fees. There's no, it just flows back and forth. What that does is it allows the SDIRA investors to pay a flat 21% tax, which is the corporate tax rate, instead of getting hit with UBIT. And it also simplifies your filings. We have not done this in the past because you got to pay the 21%, right? So the project has to have a bad enough UBIT exposure in order to make it worth it. But this project is looking like the UBIT exposure is going to be too high for an SDIRA to come directly into the project. So we're in conversation with tax and legal currently. So for you self-directed retirement folks out there, don't worry. We got you taken care of. We're going to be rolling out the UBIT blocker here in a couple of weeks, we hope, unless we hit some sort of a roadblock, which it doesn't look like we will. TJ, was that clear as mud? Yeah, he's giving me a thumbs up. Okay, sounds good. Let's see. For John and his team, what kind of employee turnover rates do you typically experience in the senior living facilities? I think John touched on that already. What does tenant care liability risk environment look like? That's a great one.
Tate, you may want to go back to that other one real quick, because we've got another investor in some of our acquisitions and one of our expansions where they asked John that same question about turnover. And I think John discussed longevity of some of the key employees and a lot of frontline employees too. But John does not use agency. And a lot of senior living providers won't show a lot of turnover because they use employment agencies. And then people who don't understand the calling, like John said, to come in and that they're going to be dealing with residents who have memory issues or who may need help being fed or with their medicines and things. And so a lot of times you don't want somebody who doesn't have that calling or that empathy to be in a job that they don't like. And so I think John does an exceptional job of identifying and hiring well, but also helping people move on if it's not their calling. And so in the absence, if you look at some things, some people have a lower number because they use employment agency and they just call that one employee. But John and the team really interview well to make sure they're getting people who care for the residents. So it's higher than multifamily because you're asking them to do a lot more.
Yeah. And we really work hard on our culture and the why behind the job and the profession. The paycheck is nice, but it can't be the only reason that you're there. There's a bigger calling behind it. And so we work hard at recruiting the right people and then, training them well and then retaining them as long as it remains a fit for them. Like I said earlier, a lot of our frontline caregivers are using this as a stepping stool on their career path. And so they're not going to remain a certified nursing assistant their entire career. Some might, but most are going to move on to other things. And that's good. We call that good turnover, where we succeeded in helping them, get up to another rung on the ladder. But turnover is an issue that plagues this industry. But we feel like we do good comparatively with our competitors. We see a lot of employees try a competitor out and then come back to us because they like our culture.
Thanks, John. This is a good question. What does the tenant care liability risk look like and how do you manage it?
I'll take a stab at that. And so, we live in a litigious world. And so anyone can bring a, lawsuit for anything. And when you're dealing with people's, precious family members, patriarchs and matriarchs of their families. We deal in some sensitive situations sometimes. And so managing expectations on the front end is so important. And that starts with, what Carrie does and her sales directors in setting the right expectation. When your mom's 90 years old, you've got to understand that, she can still live well, but there are, probably, getting older is not always pleasant. And so we guide families through that process. But I guess the real answer the questioner is looking for is, we have a great liability, professional and general liability insurance. You as the investor will not have any liability exposure. That's all with us. And we have a good loss history. And we've actually seen renewal rates kind of flatten out here over the last year or two.
And John, there's a lot of tools coming out, like some AI driven tools and other things where it helps for the operator to really evaluate if somebody's a fall risk or they've had a propensity to be unstable when they walk. So there's a lot of tracking that goes into being able to communicate with the families. Hey, your mother is not as stable as she once was. She really needs care in the shower or help getting dressed, because when they don't see their family member all the time, then they don't see maybe that downward progression of health. And so the team is really well trained on how to communicate those changes to the family members.
That's right. And this property will have an on-site therapy clinic. And so we'll have a third-party therapy provider that occupies that space and that's evaluating residents regularly and working with them on their physical therapy, speech therapy, occupational therapy, and working closely with our team to be proactive. And then most people that move in with us live with us indefinitely. And so we partner with hospice services quite frequently and help people in those later stages of life too.
A couple really good questions that came in addition. Back to the financials, Dustin was asking, how sensitive are the target returns to the refinance portion of the plan? I'm going to start with that one, and then Dustin's got a follow-on question. Kevin, we were talking earlier about this, that if, God forbid, we see a big spike in interest rates and we have some difficulty getting out of the construction loan into an agency loan, a permanent debt solution for the property, what does that look like? And the answer there is we have a nice long runway on the construction loan. But let's talk about that.
Yeah, right now we're in the process of working with the lender to basically either have a 3-year construction loan with 2 6-month extensions, or just to do a 4-year initial loan. And so that gives us runway well beyond the initial construction and lease up period. I think that even during interest rate spikes, when HUD and Fannie or Freddie, really the agencies that we'll look at to help us refinance this out, they don't have the same rate pressures maybe that you would with another bank. So once we start to lease up and get towards stabilization, we'll begin that underwriting. And again, part of it is when you look at the appraisal, that even if rates go up, if you've had that value creation, you can still absorb a lower loan and just maybe don't have as much cash going back to the investors at refi, but you're able to pay off your original note for sure.
Exactly. And so if I can speak to the effect that would have on the target returns, it really would have an effect on your cash flow, because once we finish the project, we lease it up, there is expected to be a pretty healthy cash flow stream to investors while we're operating the project prior to a sale. And so if we were stuck in a construction loan where we had a higher interest rate, that would affect the cash flows to investors, but it wouldn't change the exit price or the exit results.
And we're modeling, Tate, in the financial model right now. I just pulled it back up. We're modeling for our perm debt, 6 to 6.25%. And that's about where the market is on agency right now. So we're not betting on the market going back to 4.5% or 5% rates.
Right. Yeah. That's why we like the underwriting. The follow-on question was, why a 7-year hold if we're expecting to be fully leased by year 3 or 4?
Well, we've been working on this project for a long time, and we're not very good merchant developers. When you're merchant developers, that means that you're basically having to sell it as soon as you finish construction or start getting leasing, moving towards stabilization. And a lot of our investors, like Tate said, are family offices or high net worth individuals. And so they focus on multiples more than they do IRR. So if we were to sell in, let's say, month 40, you may have a really high internal rate of return, but your multiple is pretty low because you haven't received that cash flow or you haven't benefited from the large sale. So what we're trying to do is is give ourselves enough runway with 7-year investment cycle to know that we can work around, like Tate said, some sort of anomaly. But at the same time, we'll be meeting, our Tate's asset managers, our asset managers, we're going to be meeting very regular. We're going to be giving quarterly reports so that we all make the best decision on what to do with the facility. Like we said, we think we're designing something that people already want to buy. And so if there's crazy pricing, in year 4, then we're going to make that decision. But we don't want to plan on doing something prematurely and everybody expect to receive all their money back in year 4 if that's not the best decision for all the investors.
Yeah, we've talked about this a lot and gotten this. That's a great question. We've gotten this question from our friends and family investor group too. And what we've been telling them is that, we're giving ourselves 7 years in case we need it or in case we need it or want to ride it out 7 years. But we think there'll be opportunities before that to exit if we choose.
Who are the ideal buyers of this?
This is your classic REIT food and institutional, this is an institutional class A.
Insurance, pension funds.
That's right. We already work with a couple of REIT partners where we've sold them assets and stay in to manage the product for them. So those are the kind of opportunities we'll be looking at. But there will be no shortage of buyers knocking on the door. We know that.
And I want to double tap on what you just said. There's optionality in terms of whether Fellowship stays on as the operator. If a PE group comes in and wants to buy it, but they don't have the internal capability to run a property like this, they would obviously pay Fellowship a management fee to operate the property, and they would just own it. You could also have a Ventus or a Welltower REIT that would come in and say, no, we're going to install our own management there.
Exactly.
Yeah. All right. Last question. Any bars on the facility? And this is from Alex. We were talking about things that are open to the public, not bars on the windows, bars like, to get a beer with your mom and dad.
We do have at our Ponte Vedra property, one of the biggest activities, the most anticipated every day is a 3:00 happy hour. And so again, we're there to help our residents live the life they want to live. And so if having a happy hour is important to them, then by all means, we're going to make that happen. There are multiple, food, beverage venues throughout the property. There's your main dining room, and we have a bistro. And so, yes, I know when we were selecting the kitchen equipment, there was some debate over whether to get the draft beer, I'm lost for words, the draft beer, fountain or serve bottles. So that's absolutely, on our minds, and we'll be reading the room with our residents, prefer.
Very good. Well, Alex says his mother is currently in Alabama and all the ladies love the pub. So I think that's nice. A positive vote. With that, TJ, am I missing anything? I want to make sure we cover all the bases before we log off, but we appreciate everybody. What do you think? Anything I missed?
Hey, somebody did ask if this was skilled nursing, and the answer to that is no.
Thank you for catching that.
This does stop short of skilled nursing.
It does stop short, but that's by choice. We don't want to be a skilled nursing provider. We feel like skilled nursing is even more highly regulated than this product. We are licensed, will be licensed by the state of Florida. And in most cases, in the assisted living, memory care environments, people can live out their lives in these settings unless there is a 24/7 skilled need. Most skilled nursing residents today are there on some sort of rehab stint, or they're low income and are there because the state has a Medicaid program to pay long term. This is 100% private pay. People will choose to be here, or it'll be needs based for the memory care and assisted living. And Tate, you've done a good job presenting this, you and your team, and we could not be more excited.
We're excited to have been introduced to you, to have gotten to know you, and really excited to see this project, become a reality. So thank you to everybody who participated on the webinar. Thank you even more for those of you that plan on coming in. Let's make this thing happen.
Let's do it.
All right. Thanks, everyone.
Thank
Appreciate
you.
your time. Have a great evening.
Okay.
We'll see you.
See you later.
Bye-bye.